Morgan's Chief Economist Michael Knox. Thanks for your time today, Michael.
Thank you, Tom.
You've recently written about peace in Greece and how you thought that the shock to the stock market would be short-lived by the Greek turmoil. Are investors out of the woods on Greece yet?
We are for now. What the Greeks were looking for was 50 billion euros to tide them over so that they could make their payments to the International Monetary Fund and the European Central Bank. It looks like the deal they've done with the Eurogroup is for 85 billion euros. So they've got the money that they were looking for, and they've got an additional 35 billion euros from various European funds to invest in infrastructure. But in order to do that deal, they've had to surrender the ownership effectively of some of their own publicly owned assets, which will then be put into a trust, which are held by the Eurogroup. And when those assets, which are supposed to be worth 50 billion euros, are privatised, as they will be over the next few years, that money will go for projects for reinvestment in the economy, but about 15 billion euros will go into repayment, or 12.5 to 15 billion euros will go into repayment of existing debt. Really, that's not a bad deal, but they've lost a significant amount of sovereignty in doing it. The real problem that remains, though, as we've said in the piece we wrote about this, is that Greek debt still is unsustainable in the long term. It still needs to be restructured in the long term. The IMF is saying exactly the same thing, that the Greek debt needs to be restructured before they will be part of this program. And unless that happens, this whole problem of Greece will explode again in about 2 years' time. But the good news is that the IMF might actually persuade the Eurogroup and the European Commission to do the restructuring now. If that can be done, then we may have solved this problem for as long as we need to, Tom.
So stability in Greece for the time being, which investors seem to be reacting to.
Yes.
Meanwhile, China seems to have taken over as the pressure point of concern for investors. Can you interpret for us what's going on with the Chinese share market and the underlying confidence in that economy?
It's important to distinguish between what the stock market does in China and what the stock market does in, say, the US economy or the Australian economy. In the US economy or the Australian economy, the stock market is extremely important as a way of raising bank capital. The big banks are all floated in the US stock market and raise money through the US stock market, and the big banks in Australia are all floated on the Australian stock market and raise capital through the Australian stock market. And in that circumstance, what happens in the stock market is really important to the banking sector, and the banking sector is really important to be able to provide money for investment and therefore employment. So therefore, in our system, if the stock market falls over, the banks can become short of capital. Therefore, there's less investment in those economies. Therefore, there's less growth in those economies, and economies can fall into recession in that circumstance. But that's not the situation in China. In China, all of the big banks are owned by the state. So nothing that is happening in the stock market in China, no matter how dramatic it appears or how US commentators will think of it, actually has the damaging effect on the Chinese economy that the same kind of stock market action would in the US or in Australia. So I think the effect of the major stock market sell-off in China is amazingly little. Now, for the next quarter, we've actually revised upwards our growth estimate of China by 0.2%, rather than knocked it down. But we think the Chinese economy over this year, it's slowing to about 6.8% for the full year, and next year it's slowing to about 6.3. But that's really because of the structural change in the Chinese economy, moving it from a manufacturing economy to a service economy like ours. The Chinese stock market will probably sell off a bit more, but monetary policy is easy in China, and as long as monetary policy is easy and the Chinese government has thrown even more money against into the Chinese stock market to support it, as long as money continues to be easy, the long-term path of the Chinese stock market is up. So what I think is there will be another sell-off in the short term in Chinese stocks, but then you'll see a longer-term recovery in Chinese stocks take place. But interestingly, there's almost negligible effect on the Chinese economy.
Michael, thanks for your time.
Thank you, Tom.